Greetings, everybody. All right, let's talk a little bit about doing things on the short side, meaning making an investment and hoping it goes down. When I use the term short and when most people use it, it's more of kind of like a generic term. It doesn't really technically mean that you're short a stock. Like, for example, if you're long a put, which will go up when the market goes down, you could theoretically say, well, I'm on the short side of the market. So a lot of people are afraid of being on the short side or getting involved when the market is going down, but it's a lot of ways it's easier to make money when the market is going down because it goes down faster than it goes up. There's a reason for that. People buy based on hope, but people sell based on fear. And fear is a much more powerful emotion. So it makes people act much more aggressively. So let's just take a look at a couple things here that are going on in the market. That's the S&P. But first thing we're going to do is, believe it or not, we're going to take a look over here at copper, the old copper market. And this illustrates an important principle. Now, before I get into this, let me just say, if you do it right, and most technical analysts really don't know their ass from their elbow when it comes to this stuff. If you do it right, what we're looking at is a graphical illustration of investor psychology. All right. We get up here around 465 and we sell off. Get back here recently, or earlier this month or late in September, and we hit resistance at the same level. Why is that? Is that just some random coincidence? No, it has to do with what we call buyer's remorse. There's people who bought up here who regret their decision to do so when the price goes down. And they say, if it ever gets back to my price, I'm going to sell and get out at break even. So if you have enough remorseful buyers from here placing sell orders here, it creates resistance at the level that was resistance before. Now, a lot of times when we get to resistance, we sell off. Why is that? Well, resistance is a large group of traders and investors who want to sell, right? And some of them start to get concerned. They start to think, gee, I'm getting nervous here. If if someone is willing to sell at a lower price than me, that's who the buyers are going to go to. And I don't want to miss my trade. So I'm going to reduce the price I'm willing to sell at. Other anxious sellers see that and they do the same thing. And it results in a snowball effect, which can push the price lower. So we can go take a look at JP Morgan and what could be more different than JP Morgan and copper. Now, JP Morgan has run into resistance, hasn't turned yet, and there's no guarantee that it's going to, but it's just something to keep an eye on here. And I'm going to bring up one of my favorite indicators, Bollinger Bands. Now, this upper red line here is 2 standard deviations above the 20-day moving average. 95% of trading is supposed to be within 2 standard deviations. So if we get above this or we see this threshold, it's considered to be overbought. This is another indicator, RSI. It's also showing it to be overbought. Overbought means something's trading above its typical or normal range, and that's going to draw sellers into the market because they're going to be expecting a reversion. A lot of Wall Street strategies are based on this concept of reversion to the mean. So these are two different ways of measuring it. In these indicators, which are pretty much in any software, there's dozens, if not hundreds of them. Believe it or not, most of these are different ways of measuring the same thing. Sometimes I see newer traders, they have like 10 of them on their screens, and that's just kind of silly. I mean, I like just the basic Bollinger Band and the basic RSI. That's all I've ever used. And if you just pick a couple, you really start to learn the nuances and so forth. Another thing I'd like to point out about these indicators is they all come with defaults. So here, the RSI is the length of the measurement from one point to the other, which is momentum, is 14. Why is that the default? My guess is whoever invented this thing, I think it was a guy named Wells Bilater, made it 14. But some stocks it might work better on if it's 10. Some stocks it might work better on if it's 20. If you trade just a narrow range of stocks, my advice is to spend some time uh, looking at these default settings and seeing if there's something that fits your strategy better. Here we have another default. If it's above 70, it's considered to be overbought. If it's below 30, it's considered to be oversold. And those measurements are down here. This is the RSI line. So above 70, it's considered to be overbought. But think about it. If the market's trending higher, then maybe 70 isn't overbought. Maybe it has to get to 75 to be overbought. If a market's going lower, being oversold would be a bigger move than if a market is going higher and is oversold. So you could adjust accordingly. And yeah, all right. So that's JP Morgan. Now we're going to go look at Bitcoin. And what do we see here? The same action that we saw in JP Morgan. We get to resistance, we run into a resistance level. If some of these sellers start to get nervous and they think they're going to miss out, they're going to start to undercut each other, and that's going to drive the price lower. And last thing that kind of caught my attention was Ford Motor Company. This is a stock that really likes its price levels, but this is something that I would have on my radar or my radar screen. Gets to resistance, sells off. People regret buying. Goes lower, gets back up here. People that regret buying get out at break even. That creates resistance. Some of the sellers start to undercut each other and we go lower. So if we get back up to around 11:30, this morning we're trading at 11:15, it's a good chance this reverses and starts to head lower. All right, everybody, I hope that helps, and I will see you soon.